We're to our first topic today. Of course, the Monetary Policy Committee of the Central Bank of Nigeria, for the first time in 2.5 years, has increased the monetary policy rate to 13% from the previous 11.5% benchmark. Well, this fresh move tilts to the earlier narrative analysts had projected of a rate hike of at least 25 to 50 basis points. Governor of the CBN, Mr. Godwin Emefiele, describes this as the best and compelling move to tackle the most urgent issue of inflation. According to the Apex Bank governor, other key parameters have been left unchanged, with the asymmetric corridor at plus 100 and minus 700 basis points, cash reserve requirements at 27.5%, liquidity ratio at 30%. The MPC, which is the third for the year, saw members of the committee confronted with a choice to hold all policy parameters constant, to allow policy measures to sustain growth, to tighten the stance, a policy curb to curb money demand growth, and development of domestic prices. Well, joining me via Zoom to look more into the resolutions made at the just concluded meeting is a fiscal policy partner and Africa tax leader at PricewaterhouseCoopers, Mr. Taiwo Oyedele. Thank you so much for your time, Mr. Oyedele.
Thank you for having me, Tolu.
Yes, I'm sure you watched the CBN governor yesterday when he was rolling out the resolutions after that meeting. Before I go into some more details, this 13% MPR rate is quite sharp. Move away from conservative stance we have seen from monetary policy committees. What were you thinking? Do you think this was the best move to rein in inflation?
Yeah. So I think, if you look back, the last time that we had a significant increase was in 2016 July. At that time, the MPR was increased from 12% by 200 basis points to 14%. So this is about 7 years ago now. We haven't had a significant adjustment since then. We had some adjustments in 2020. We also had in 2019, but were mostly 50 basis points and at most 100 basis points. So this is not something we have seen in a long time. When this adjustment of 200 basis points was made in 2016, in fact, inflation continued to trend upwards compared to the previous year by up to 6.7%. So that inflation moved from 9% to 15.7%. At the end of 2016, and GDP declined. If you remember, this was one of the period when we entered the recession. GDP declined by 1.62. The circumstances are different today than they were in 2016. We're having, I think it was the World Bank that called it a confluence of challenges. You're having COVID-19 hasn't left us. We're also having energy crisis because of what's going on in Ukraine. And on top of that, you're having food scarcity, also in a way associated to the crisis in Ukraine, but also many countries now locking down their food. During at the height of the pandemic, we had the lockdown of people, but now we're having the lockdown of food. Everybody is saying, I'm going to limit my export because I have to take care of my people first and foremost. And to that extent, not only are we having challenges with supply, we're also having issues with imported inflation because already there is high inflation everywhere in the world, from Europe to the UK to the US to Asia. They're seeing record, maybe not record, but high inflation that they haven't seen in decades, such that in countries like the UK, this is becoming a cost of living crisis for them. And for a country like Nigeria, where we import a lot, what that means is what you're importing is more expensive in foreign currency. On top of that, you're having depreciation of the Naira, which means when you translate this into Naira, it becomes a lot more expensive. So I think, and if you also think about growth is not really robust. I'll say we just have fragile growth. We're talking about 3% or thereabouts for GDP growth rate. when you also consider that our population is growing at about that percentage. Over the past 10 years, if you find the average of real growth rate is been less than 2%, somewhere around 1.9, much below the population growth rate, which is not surprising that we're having more people getting into poverty, and at some point we're considered to be the poverty capital of the world. The reality is that there are no easy policy choices. When you find yourself in a complex situation like this, you need to make sure you bring inflation under control. You are concerned about growth, especially inclusive growth, but also above all of that, you are concerned about social stability. Because if people cannot find what to eat, or they can no longer afford a meal, they become irrational and they become dangerous to themselves and to society.
A very good way to start this discussion. But let me follow up by some analysts have said that rate hike like this should be done gradually. Some say 25 basis points, 50 basis points. We can go on and on that way. But they're saying this response even seems to be a bit late. Is it better late than never? Or what do you think about this?
Yeah, I don't think it's a question of, better late than never. It's even still a question of whether this is the right thing for us to do, right? We certainly want to bring inflation under control. We also want to continue to have growth. We want to have robust growth in the region, I'll say 6 and 7%, before you can actually say that you are lifting people out of poverty. And we have to remind ourselves, such growth must be inclusive, not leaving the majority of the people behind. My expectation yesterday wasn't that there was going to be 150% adjustment to MPR. Of course, we need to remember that other rates were kept, were retained. There was a hold on, liquidity ratio, cash reserve ratio, as well as the asymmetric corridor. But MPR is the major area where we had this significant adjustment. I wasn't expecting something as high as 150 basis points. I was thinking maybe a 50 basis point adjustment, and then you allow that to settle in for the economy to take it in, and then you see whether it's giving you the right results. And then if you need more adjustment, you could do another 50 basis points or thereabouts. If you think about other countries, Pakistan, for example, is facing significant challenges. They are actually now very close to defaulting on their debt. And they also just on Monday made an adjustment of 150 basis points to their interest rate. So Nigeria is not close to that. So I wasn't expecting it to be as significant. We then need to be very deliberate and intentional in ensuring that this monetary policy adjustment is complemented appropriately with other policies, particularly fiscal policy. Otherwise, you may find that this is a step change and it could disrupt, a lot of things. Imagine, the private sector, manufacturing and businesses with their loans. You just expect very soon you're going to get a letter from your bank telling you that your interest rates have been adjusted upwards. On top of this is the fact that at the beginning of the year, on the 2nd of January, the exemption order on corporate bonds and other securities like commercial paper expired and it was not renewed. That in itself meant that the cost of raising capital by way of borrowing had gone up as at the beginning of the year. So this is an additional increase on the cost of capital. And we also know that the capital market, even though there has been some improvements in terms of performance recently, this would also affect the capital market negatively. We already saw some decline, and it's not easy now to raise equity by way of finance. So what the private sector is relying on is debt financing. If debt financing is becoming too expensive as a result of the combined impact of expiration of tax exemption and now the adjustment to the MPR, we really have to be careful that this does not result in significant negative impact on economic growth.
Let's take it from there, Mr. Oyedele. 150% hike. Let's look at the impact now on lending, on the financial space, investors' confidence. It's like 3 in 1. But let's highlight some of the effects of this on this 3 set of people.
Yeah, maybe you can take it again. I really didn't hear you. It
Okay,
wasn't clear.
I'm talking about this significant move by the Apex Bank. What is the implication on lending for the banks and, of course, for investors?
I see. Yeah, so there will be certainly implications for the banking sector, financial services sector. There will be implications for the private sector. There will be implications for government. So let's take it one by one.
Yes.
So the financial services sector, particularly banking, for them, this is probably good business. Good business in the sense that they're going to earn more. The adjustment they're going to make to their own lending rates will have to be more than 150 basis points. If you have to remember that there is the cash reserve ratio, liquidity ratio. So all the money that you give to the bank is not available to them to invest. So they have to make that proportionate adjustment. So banks are likely to earn more. And because banks also earn a lot of exempt interest income, particularly on government bonds, which means they may have higher profits that are also exempted from tax. But that's barely where it stops. When it goes to the private sector, which is the bulk of the economy, where they have to borrow to finance their activities, whether it's manufacturing, whether it's services, whether it's technology, they're going to see a rise in their cost of capital and therefore the cost of doing business, which means their ability to expand is going to be limited. Because if you cannot invest sufficiently enough, then the ability for the economy to grow is compromised. And for government, just reminding ourselves that government is in serious deficit. So we have deficit financing, which was already big enough. And on top of that, we have to borrow more, or at least raise the deficit because of the subsidy of 4 trillion naira. All of this, a significant portion of that is domestic financing. So government is going to be going to the domestic market to issue bonds and treasury bills. The rate at which they have to borrow will go up. What this will do is it's going to compound the debt service ratio to revenue. At some point, that ratio was close to 90% for the federal government. If the rate at which we are borrowing is going to go up, we should expect that that ratio would also deteriorate, which is not good for Nigeria's standing and even maybe credit rating. So these are some of the implications that we can see for the ordinary man, ordinary woman on the streets. This could easily mean that the price of bread and milk will go up. But on the flip side, it could mean that exchange rate will strengthen because when you raise your interest rate, you should be able to attract more investment in terms of foreign portfolio investment. But unfortunately, because of the scarcity of dollars and the various windows we have and the big margin between the official rate and the parallel rate, I'm not really too optimistic that we're going to see a lot of inflow from foreign portfolio investors.
Now, for the economy, we've seen GDP figures, we see that gradual growth, or the fragile kind of growth. What's your outlook moving on, Mr. Udele?
Okay, so I figure what you said is outlook around growth.
Yes. Moving on.
Yes. So, like I said, in 2016, we had a 200 basis points. That's 2% adjustment to MPR. And then we had a decline in GDP. GDP currently is trending at about 3%. With this increase, I think my projection for growth, unfortunately, will be something in the range of 2 to 3%. But of course, I know that these are dynamic issues and you may have an adjustment again to the MPR maybe by next quarter. But overall, if we leave it as it is, you would expect that this tightening would make it difficult for us for the private sector to raise the needed funds for investment. And like I said earlier on, without investment, it's not going to be very easy to have the kind of growth that we're looking for. So my projection would be, very small growth of between 2 to 3% for the year, unless this policy changes or we see the impact, flowing out differently.
In one word, before you go, Mr. Udele, the CBN's intervention, they talked a lot about this and they said they will sustain this. Do you think that could help us achieve inclusive growth?
Yeah, and I think it's a good thing that for development finance, the CBN says they're going to sustain the 5%, which is good. But if you think about the credit to the private sector, as at the end of last year, the credit to the private sector was about 37 trillion naira. The development finance that the CBN is talking about is barely 1 trillion. So it's a drop in the ocean. So the percentage of that 5% finance to the entire credit to the private sector is insignificant. So I do acknowledge it's good that the 5% is going to be retained, but we need to think about what happens to the other people who don't have access to this development finance and have to raise their interest at very high rates. What business can you do in Nigeria today to be able to cover interest that will be close to 20? For some people, this will easily mean borrowing at 20 or plus percentage. So, maybe we need to think about a broader, intervention for the whole economy rather than something that is targeted as just a few people.
Indeed, it's a good way to live it. Mr. Taiwo Oyedele is a fiscal policy partner and Africa tax leader at PricewaterhouseCoopers. Do enjoy the rest of your day and thank you for your time.
Thank you for having me.